Hey investor friends, I'm Michelle Markey, and today I've got a checklist for things you can do to prepare for the next recession, because after the stock market has had monster returns from 2019 through 2021, Wall Street is projecting only average returns of 4% in 2022. So are you sitting in a stockpile of cash, or are you spending down what you socked away in the last 2 years, or are you YOLOing your gains in the markets? Either way, it may be time to re-up your cash hoard, because if you thought the prospect of a recession is over, think again, and not to fear, because I've got some suggestions for how you can stay prepared no matter what curveballs the markets may throw at you. And it would mean a great deal to me if you could please like and subscribe to my video and YouTube channel, because I put a lot of work into this, and I believe that we can be financial fortresses and not only survive the next recession, but thrive. So thanks for doing that. You might be lulled into a sense of complacency with Fed Chair Jerome Powell saying that the economy is so strong that the economy no longer needs aggressive stimulus, and that there's no need for a delay between tapering and raising interest rates. But it's like the calm before the storm, as even though Michael Burry has become a boy who cried wolf with all of his mother of all crashes warnings all the time, it seems like there are others who are being cautious, because people like Elon Musk are warning that a recession could come as early as this spring 2022 and latest by 2023, or how a Forbes author believes that it's more likely for a recession to come in 2023, or also how Harry Dent believes that the recession is coming in early 2022, and then Jeremy Grantham's warnings are still valid that he made in 2021. All of the conditions that were present in 2021 are still here today, so that's also something to keep in mind, as well as how a chief strategist named David Hunter believes that the market, the S&P 500, could rise to 5,300 before crumbling by 80%. So this could be the granddaddy of all tops, as David Hunter said. And so this is something all to keep in mind. And while nobody knows if markets and the economy will continue to do well, it's something to consider how we should prepare and be ready no matter what happens. So I use these tips in my everyday life, and I think they can be helpful to you too. Tip number 1 is build an emergency fund, ideally for 6 to 12 months of your living expenses and bare necessities, because with stimulus payments winding down or done already, now is the time to make sure you have enough to be able to survive on your own without needing anyone else's assistance. And during the 2008 Great Recession, people were unemployed for an average of 8 to 9 months. And when you have unemployment claims, you generally get only 60% of your weekly wages that you had before when you had a job. So keep this in mind if you need to be able to shore up extra funds to be able to cover the gap that's not covered from unemployment funds coming in if you end up on unemployment. And in addition, while there's not many assets that can keep up with inflation at rates of 7% right now, the best that you can do, and what I would do, is keep my reserve cash in a highly liquid and high interest bearing type of account, such as a high yield savings or checking account getting 1%. And while I know that my reserve cash is still losing 6% to inflation, at least I have the peace of mind knowing that I have ready firepower to deploy no matter what calamity happens in the markets or the economy. And I can rest assured that I can take care of myself and cover all of my bare necessities, like having shelter and food and transportation and clothing and all of the basics to be able to survive in the worst case scenario. Tip number 2 is have a healthy relationship with debt if you have some, and have a plan in place to make sure all of your debt payments get covered. And of course, it's ideal to not have any debt if you can help it. But if you do have debt, it's all right, like especially if it's mortgage debt, because you should understand the effects of inflation on any debt you might have. And with CPI inflation at 7%, this means the purchasing power of your dollars is being reduced. And if you were able to buy a dollar's worth of goods last year, today you can only buy 93 cents worth of the same goods today. So if you have low interest mortgage debt, you're actually ending up on top, and you're actually almost being paid to borrow money with inflation at 7% and your interest rate on your mortgage mortgage is 3%, that means you're ending up 4% ahead. And this is kind of not a bad gig. So don't be in a rush to pay off your mortgage anytime soon, especially if inflation stays high and erodes the value of your mortgage debt. So you can pay back your mortgage with cheaper dollars tomorrow, and it's kind of no big deal. So you're in a good place there. But when it comes to credit card debt, and if it has high interest rates of something like 18% or more, you really don't want to hold on to that kind of debt, because it's almost like insult to injury if you have less worth dollars trying to pay off the kind of barrage of high interest credit card payments that are coming due every month. It's sort of a losing battle. So you don't want to do that to yourself, and you want to make sure you get rid of high interest credit card debt as soon as possible. And if you've been paying your credit card debt payments on time, then you want to call your credit card provider and let them know that you'd like to have a lower interest rate on your credit card debt, and then pay that off ASAP. Tip number 3 is evaluate your spending habits, and all the stimulus and money printing is designed to get us to spend or borrow money. And what if you lost your job? Would you still be prepared to cover your bills and credit card payments and your rent and or mortgage payments? And also, if you have student loans, are you prepared to resume payments on those starting on May 1st, 2022? And right now, workers are in a great position to have negotiating power to ask for higher wages in an increasingly inflationary environment. But what if the tables turn on us, and then all of a sudden jobs were to dry up, and then people were not able to get as much governmental stimulus help as they had before? They're going to need to be able to cut costs and also raise cash from somewhere, and that might mean having to sell assets or work odd jobs to make ends meet. And also, we know that demand has been surging over the last couple of years as people needed enough computers, smartphones, and cars to be able to survive at home during lockdowns where the economy contracted and GDP declined by 3.5% in 2020, only to be propelled really high up to 5% or so in 2021. And you have to ask yourself if this amount of demand is likely to continue in 2022, or if a lot of people are satiated, because a lot of people are saying the economic recovery is being driven by a lot of consumer demand. But what if we have enough stuff and we no longer crave as many things to be able to get by in life? So you have to wonder what is going to happen with the economy in 2022, and if it's going to resume more of a normal pattern. So there's some projections that the economy would still grow by 3.9% in 2022, which sounds good, but what if there are some other factors that we don't know yet that might happen, like somehow the tables turn and maybe people start having less access to jobs, or there might be some black swan event that causes some kind of big scare. Nobody knows what's going to happen. And so what I would do rather than spending is I would save like there's no tomorrow, because you just don't know if there's going to be something that really causes a big scare in the markets, and if, let's say, supply chain issues continue to be a drag on the economy, or never mind some of the public health concerns. So it pays to be prepared and to be really conscientious of anything that you need to be spending your money on. Tip number 4 is learn how to invest and gain an understanding of what happens during inflationary times and recessions. And right now is the best time to learn how to invest or to level up on your existing investing knowledge. And feel free to check out one of my videos of how I like to analyze and pick stocks. And I also like to draw inspiration from some of my favorite investors, Warren Buffett and Charlie Munger. And I like to keep this quote in mind, especially right now with where markets are, where Warren Buffett said, "Be fearful when others are greedy, and be greedy when others are fearful." And I say this because there's a Buffett indicator that measures the overall valuation of the stock market. And right now, if we look at the Buffett indicator, it shows that the total market's value to GDP is above 250%, and that's pretty incredible. It is so high that this is more than double what it would be at fully valued, and so it kind of is a big warning signal to me. And more practically speaking, what you should be doing is start putting together a list of your favorite companies that are ideally wonderful companies, and these would also be companies that you can believe in and that you would like to invest in and own for at least 10 years. And it doesn't mean that you're going going out and buying these companies right now today, but you're waiting for there to be a significant event that makes these company stocks go on sale, and then you can buy them at a significant discount or at a margin of safety so that you can be able to enjoy, even if your judgment was not fully correct, in the stock price's appreciation over time, and then be able to enjoy a lot of gains thereafter. And what this means to further expand, we get a lot of the lessons of how we should invest from Charlie Munger, where he said that in order to invest, you should find companies that have wonderful managements with integrity and talent, and also a company that has a business with a durable competitive advantage known as its moat. And you should also be able to have a margin of safety, like I mentioned before. And in addition, you want to invest in companies that will not only survive during recessions, but also thrive in them. And that makes them anti-fragile. And some of the winners of 2020 were companies like Costco and big tech in general, because everybody needed food and a lot of people wanted goods delivered, and a lot of people wanted a lot of tech products to pass the time while at home. So those were some of the companies that not only did well during the downturn of 2020, but also did way better and generated some really high profits during tough times. So you want to be able to look at businesses that will continue being able to generate enough free cash flows, even when there's a lot of significant economic headwinds, and that means they have a pretty tough business moat. Tip number 5 is figure out a stock buy price and how much cash you plan to allocate into buying the stocks when their prices have them on sale. So what this means is you have to do some research and homework with your list of favorite companies, and then figure out, based on doing some discounted cash flow analyses or other kinds of valuation calculations, what is an appropriate stock price to pay for your wonderful company that ideally you'd like to buy on sale. Because if you pay for stocks at current prices, the likelihood of getting your expected rate of return could be a lot lower than if you buy them when they're on sale, and then you might have a much higher expected rate of return in the future. So just determine what are those kinds of stock buy prices you'd like to have, and have them ready in front of you when you think there could be a massive event that makes stocks go on sale, and then you're ready to deploy your cash and then buy wonderful company stocks when they're on sale. And in addition, you have to decide how much cash you're willing to have available that's not invested right now, so that you can have some ready firepower to be able to invest with when the company stocks are on sale. And even if not a lot of assets are bargains right now, that doesn't mean there aren't some undervalued securities that you might be able to invest in right now. And so you just have to decide how much cash you're willing to have on the side, waiting for an opportunity to invest, whether it's during a recession or not. Tip number 6 is use your human potential to generate more money. And so what this means is, if you've done everything you can to prepare and followed all of my previous 5 tips, what you can now do is think about how can you yourself generate more cash flows. And so what this could look like is, let's say you have certain skills and you might want to freelance or consider starting your own business. And you can do this especially if you've already prepared for any kind of economic condition that might happen, as I discussed before. And then you might now be in a position where you're able to invest in yourself, or be able to invest some available cash into starting your own business. These are all great ways that you could potentially be earning more money than just from a 9-to-5 job. So think about all the ways that you can pursue your passion projects and also help society and the world by bringing your business ideas to life, and also contributing your unique skills to be able to help someone, and then you get money in return. And you have to think, what do you have to lose if you've already done everything else that you can? And this might be the best next use of your time. Tip number 7 is know your investing temperament. And what this means is, before there's a market meltdown, you should already be mentally prepared as to what actions you will or will not take. And be honest with yourself. You should know what your investing temperament has been like when you've been investing or trading in the last several months or years. So you should kind of know what your own behavioral finance biases tend to make you do, because we all have blind spots, and it's important to try to be aware of where our potential weaknesses might be, so that we can try to put guardrails in for ourselves to prevent us from making even worse decisions when our emotions are running hot and we see our portfolio bleeding red, everything in our stock portfolio is like losing a lot of percentage points and we think we might be freaking out. So it's important to try to have a plan in place before that situation happens so that we don't make decisions that we'll come to regret later. And so think about, if you are seeing your portfolio, are you the type of person who likes to quit while they're ahead and take some profits off the table? Or do you realistically believe that you can hodl no matter what? So it's important to know that, as well as if you think your neighbor is selling or your friend and other people are selling and they're telling you you should sell, do you think that you will listen to them, or do you think that you'll have nerves of steel and kind of have conviction in whatever your picks are? Because if you're in agony over seeing the stock prices of your picks go down like 50 to 80%, then you may not have as high conviction as though you had if you were in certain investments that you're kind of not even flinching if you see them down 50 to 80% and it's not bothering you. So you have to try to figure out ahead of time how you think you'll behave and react, even if it's kind of a hard exercise to do right now because you're not in fight or flight mode, but you just have to see how your emotions could be when it's really in panic mode and everybody else is freaking out. But do you think that you'll be able to remain calm and centered and kind of be able to hold on and be able to be okay with what you're investing in? It's important to decide this ahead of time. As bad as recessions and bear markets feel when we're experiencing them, fortunately, they don't tend to last as long as bull markets do. So in the past several decades, the longest that recessions have lasted is a few years. And most of the time, we usually have bull markets. So that's a reassuring sign. And yet you also have to keep in the back of your mind that the Great Recession lasted for a pretty long time. And when the Dow Jones reached its peak in 1929, it didn't get back to that point for a whole 25 years. So just think about that. If your stocks were to go nowhere or go down for 25 years, and what you would do if that really had to be the scenario. Hopefully that doesn't happen, but it's definitely a lost generation of investing. And hopefully that doesn't happen to us, because I have a lot of hope for millennials and Gen Zers. So I really hope that as long as we do our homework and research and we have high conviction in whatever stock picks we have, that even if our stocks go down in price for a short time, that they'll eventually recover and they'll be stronger than ever in the future. And if you enjoyed this video or learned something, please like and subscribe. And I wish you well on your journey to being the best investor you can be. Till next time.